This is Flip Video 4.1, the Federal Reserve and Monetary Policy. So we're going to look at the structure of the Federal Reserve Bank and then mainly focus on what monetary policy is, the tools of monetary policy, and look at the specifics of expansionary and contractionary monetary policy. So the U.S. did not start with the Federal Reserve Bank. It was established in 1913 in response to the Panic of 1907, which caused a lot of bank runs, which is when banks run out of cash to hand out to people, and it led to a 4-year recession. Although the actual Panic of 1907 lasted about 4 days, it led to a 4-year recession in the U.S. So they created the Federal Reserve Bank to compel all deposit-taking institutions. So deposit-taking institutions, those are just banks, to hold adequate reserves and to open their accounts to regulators. So adequate reserves means banks have to hold money in their vault, and then open their accounts to regulators means that the government was going to establish a regulating industry or multiple regulating industries to monitor banks. So the Federal Reserve was given the sole right to issue currency to ensure that the money supply was sufficiently responsive to conditions around the country. So issue currency means actually let money or currency flow into the economy, and then they can actually start to restrict currency flow in the economy as well. So our Federal Reserve System has 12 different banks in the U.S. We are located in bank number 11. It's in downtown Dallas. Prior to COVID, they had tours that you could go on and watch them do what they do in the bank. And you can see the East Coast has a higher concentration of banks because there's more people that live on the East Coast when they established the 12 districts. So at the top of the Federal Reserve System is a Fed chairperson, and then they rely on the help of the Federal Open Market Committee and the Board of Governors to make monetary policy decisions. And the FOMC and Board of Governors are just banking regulating bodies. They're just two different groups that help regulate our banking industry. Our current Fed chairperson is Mr. Jerome Powell. Our former Fed chairperson was Miss Janet Yellen. And then prior to Janet Yellen was Mr. Ben Bernanke. So Mr. Ben Bernanke helped us get into and then get out of the Great Recession. Janet Yellen was nominated and then confirmed under President Obama and helped us really thoroughly recover from the Great Recession. And then Jerome Powell was nominated and then confirmed under our current president, President Trump. You might have seen some tweets from President Trump against Jerome Powell, but he's still there, at least for now. So there are two types of banks. When the Federal Reserve was established in 1913, they separated banks into two types: commercial banks, which accepts deposits and is covered by deposit insurance, which is the FDIC insurance that we have now. They didn't have it when the Fed was established, but now we have it. And then the other type of bank was an investment bank, which just deals with trades and financial assets and is not covered by deposit insurance. For the most part, the majority of our commercial banks are now also investment banks. They work together. They no longer have to be separated. But if you are trading in financial assets, playing the stock market, you're not going to be covered by the FDIC insurance. Only your checking account and your savings accounts at your banks are covered by FDIC insurance up to a certain maximum, $250,000. So what exactly does the Federal Reserve do? Well, they have 4 basic functions. First is to provide financial services to depository institutions. So depository institutions is banks. So they are the bank's banker. They also regulate banks and other financial institutions, so they are the overseers of our commercial banks, which is like Chase, Wells Fargo, Bank of America. And then they also provide rules and regulations for other financial institutions, particularly like our investment banks. They maintain financial system stability, so they maintain interest rates, they maintain currency flow, they basically just maintain financial order. And most importantly, they conduct monetary policy. So when they are conducting monetary policy, their goal is to change interest rates to impact aggregate demand. So if you think back to class, interest rates are directly tied to which component of Sig X? Yes, that is correct. Investment spending. So monetary policy is all about changing interest rates to change investment spending, which will then change aggregate demand, depending on which economic gap we are in. So again, it's all about changing the interest rates, and they're going to change interest rates through changing the money supply. So we will get to look at two new graphs this unit. The first graph is the money market, which is directly tied to monetary policy. And then the second graph that we'll look at is loanable funds. Monetary policy forces aggregate demand through investment spending to close our economic gaps. Sometimes we can tack on consumer spending, but for the most part, we're just going to be mainly concerned with impacting investment spending, which, remember, is physical capital. It's not financial asset purchases. So there are three tools of monetary policy. The first is borrowing rates. So the Federal Reserve Bank can change the interest rate that banks receive when they take out loans. So the federal funds rate is the interest rate that fellow banks charge each other when they need to take out additional money to make loans or cover a withdrawal from their bank. So oddly enough, like Bank of America runs out of money and they need to go somewhere to get a loan. So the first place they should go is the federal funds rate. So they need to borrow from their fellow banks. So they should borrow from another Bank of America, or they can hop across the street and borrow from Chase, or they can go find a Wells Fargo to borrow from. So banks borrow from each other. Banks can also borrow from the Federal Reserve. And so the discount rate is the interest rate that the Fed charges banks when they need to take out loans. So most of the time, instead of borrowing from fellow banks, because we do have a district bank in downtown Dallas, our banks would just go borrow from our district bank, number 11, in downtown Dallas. And they would be charged the discount rate on top of the loan that they take out. The next tool of monetary policy is the reserve requirement, and this is the amount of money that must remain in the vault at all times. So it's usually 10% of a bank's checkable deposits, which is the bank's checking accounts. It's usually 10%, but over the last few years, the Fed has actually required 0% in a reserve requirement, so banks literally just loan out all their money. So the pandemic has caused the reserve requirement to actually officially become 0. So banks are just loaning out money. All the money in the bank is leaving the bank. The third tool of monetary policy is open market operations, or bonds. So we are mostly going to be seeing changes in the reserve requirement and changes in bonds as our main tools of monetary policy. So bonds, those are the IOUs, are bought and sold on the open market, which is just the technical term for bond sales. This is the most used tool of the Federal Reserve. Is super easy. They put bonds on the open market, or they take bonds off the open market. Bonds are also called treasury bills and treasury securities. So that's another way that you could see open market operations or bonds phrased. So monetary policy in action. How do we actually use these tools to conduct monetary policy? Now in class, we'll be going into a lot more detail with these and looking at how they change things. So for now, we just need to know the directions that our tools are moving in order to implement this type of policy. So expansionary monetary policy has the word expand in it. And again, we want to expand out of a recession. So our goal is to increase aggregate demand. So to increase aggregate demand, we somehow need to increase investment spending, which means we need to decrease interest rates. So to decrease interest rates, the Fed will need to lower the borrowing rates. So that will encourage banks to borrow more money so they can hand out more loans. They could lower the reserve requirement, which will allow banks to hand out more loans. Or the Fed can buy bonds, which basically just increases the cash flow in the US. Contractionary monetary policy has the word contract, which means to shrink or to slow down. So we want to contract an expansion. We don't want to stop the expansion, we just want to contract it. We just want to slow it down. So somehow we need to decrease aggregate demand. So to decrease aggregate demand, we need to discourage investment spending, which means we need to start increasing interest rates. We need to make it more expensive to take out a loan. So the Fed is going to go ahead and increase the borrowing rates, making it more difficult, more expensive for banks to borrow money, therefore limiting the amount of loans they can hand out. We also want the Fed to increase the reserve requirement, so banks will need to hold more money in the vault, therefore leading to less loans that they can hand out. Or we would like the Federal Reserve to sell bonds, which basically just removes cash from the economy. Okay. So that is flip video 4.1. Don't forget to take the comprehension check in Canvas, and you can retake it as many times as you want until you get a 100.